Imagine waking up one morning and realizing that almost everyone around you is suddenly rich. Your neighbors, your coworkers, politicians, celebrities, even people who had never invested a single dollar in their lives. Everyone seems to be making money effortlessly just by owning one thing. One stock. One promise. And if you're not in, you feel stupid late. Left behind. That feeling is not modern. It didn't start with crypto, meme stocks, or social media. It started more than 300 years ago during what became the first viral financial scam in history, the South Sea Bubble. And once you understand how it worked, you'll realize something uncomfortable. The system that fooled an entire nation back then is still fooling millions today, just wearing a different costume. In the early 1700s, Britain was drowning in debt. Years of war had left the government desperate for solutions, and traditional methods weren't working. Taxes were unpopular. Spending cuts were impossible. The country needed a miracle, and that miracle appeared in the form of a company with an incredible story. It was called the South Sea Company. On paper, it had exclusive rights to trade with South America, a region Europeans imagined as overflowing with gold, silver, and endless wealth. The name alone triggered visions of exotic riches arriving by ship, transforming investors into elites overnight. But here's the first secret most people never learn. Britain didn't actually have free access to South America. Spain controlled the region. Trade was restricted, dangerous, limited. In reality, the South Sea Company had almost no meaningful business operations at all. But that didn't matter, because the company wasn't selling trade, it was selling belief. It offered the British government a deal that sounded brilliant. The company would assume a massive portion of the national debt. In exchange, it would be allowed to issue shares to the public. The government supported it. Parliament endorsed it. The king himself was involved. Suddenly, buying South Sea Company stock didn't feel speculative. It felt patriotic, safe, official. And this is where the psychological engine started running. When authority endorses an opportunity, skepticism collapses. People stop asking how something works and start asking how to get in. At first, the stock price moved slowly. Then, something changed. Early investors began making money. Real money. Not hypothetical gains, but visible profits. Prices rose. Word spread. Newspapers talked about it constantly. Coffee houses turned into trading floors. Conversations everywhere revolved around one question. How many shares do you own? This wasn't investing anymore. It was social proof in motion. When people saw others winning, doubt felt irrational. And when doubt feels irrational, greed feels responsible. That's when the bubble went vertical. The South Sea Company leaned into the frenzy. It issued more shares. Then more. Then even more. Each new issuance was framed as a limited opportunity, a chance to buy before the next surge, and people rushed in. Not because they understood the company, but because everyone else was already inside. This is a pattern that repeats endlessly in financial history. People don't want returns. They want reassurance. They want confirmation that they're not making a mistake. And the market was giving them that reassurance every single day, as prices kept rising. Soon, something even stranger happened. The success of the South Sea Company inspired hundreds of copycat ventures. Companies promising absurd ideas began flooding the market. Schemes to extract silver from lead to ensure impossible risks. To build machines that defied physics, one infamous company advertised itself as a business of great advantage, but nobody to know what it is. And people invested anyway. That's not a joke, it's a warning. Once speculation becomes normalized, logic becomes optional. This was the moment when the entire system detached from reality, and almost no one noticed because they were too busy watching numbers go up. Behind the scenes, insiders were cashing out quietly. Directors sold shares while publicly praising the company. Politicians secured positions and privileges. The same people encouraging the public to buy were protecting themselves from the collapse they knew was coming. But the average investor didn't see that. All they saw was price momentum. And momentum feels like truth when you're inside it. This is another critical loop. Rising prices silence critics. Anyone who warned about risk was dismissed as jealous, old-fashioned, or uninformed. Sound familiar? Eventually, reality asserted itself. Trade profits failed to materialize. Confidence wavered. A few large investors tried to sell. Prices dipped. Panic followed. And once selling begins in a bubble, it feeds on itself. The same crowd that rushed in now rushed out. But there was a problem. There weren't enough buyers. Prices collapsed. Fortunes evaporated in weeks. Some in days. Entire families lost life, savings. Reputations were destroyed. Suicides followed. The British economy was shaken to its core. The aftermath was brutal. Investigations revealed corruption at the highest levels of government. Officials were stripped of titles. Assets were seized. The public demanded accountability. But the damage was already done. And here's the most important part of this story. The South Sea bubble wasn't caused by ignorance. It was caused by trust. Trust in institutions. Trust in authority. Trust in the idea that if something is popular enough, it must be legitimate. That lesson didn't die in 1720. It evolved. Today, we like to believe we're smarter, more informed, protected by regulation and technology. But the same psychological machinery still runs modern markets. Replace coffee houses with social media, replace pamphlets with viral posts, replace trade monopolies with revolutionary technology, crypto platforms, AI funds, or exclusive investment groups. The structure stays the same. A compelling story. Early winners. Authority, endorsement, social proof, urgency, and finally, collapse. The South Sea bubble was the first financial scam to spread virally, not through the internet, but through human networks. And that's why it still matters. This story is part of a larger pattern, one that includes later bubbles, famous Ponzi schemes, corporate frauds, and modern digital scams. In our breakdown of the biggest financial scandals in history, this was where it all began. Not because it was the biggest in dollar terms, but because it proved something fundamental. Markets don't fail because people don't have information. They fail because people trust narratives more than numbers. And as long as belief can spread faster than understanding, bubbles will keep forming. The South Sea bubble teaches us that scams don't always look criminal. Sometimes they look official. Sometimes they look intelligent. Sometimes they look inevitable. And the most dangerous ones don't promise miracles. They promise normalcy, safety, participation. The feeling that everyone else has already validated the decision for you. That's the oldest trick in finance, and it's still working. If you've ever wondered how entire populations can fall for the same illusion at once, this is your answer. And if you want to understand how these patterns repeat across history, across markets, and across modern platforms, this channel exists for that reason. Because the next financial bubble won't announce itself as a bubble. It will feel obvious, comfortable, inevitable, just like this one did.